everyone? Welcome to the live stream. You are rocking with me. I am Dion Rabouin, markets reporter for the Wall Street Journal. I want to welcome you into this special Thursday edition. It's a weekend edition or an end of the week edition to the live stream. Good Friday is tomorrow, so both the stock and bond markets are closed. So we are doing this special wrap-up weekly edition of the live stream today. I want to appreciate everyone who's tuning in and thank in advance all the people who will tune in, even though they won't see this. And if you're watching this on replay on the channel, thank you for watching, and I hope you'll be with us when we do it again on Monday. Like I said, this is a live stream. We're trying this out. We're going to talk through everything that's going on in markets, everything that's moving the markets, basically everything that's important if you read the Wall Street Journal, all the big news happening that's moving money around. So thanks to everybody for tuning in. I am Dion Rabouin, as I said, and we are going to get into everything. We got earnings this week. We've had some more big moves in the stock market, big moves in the bond market, and we're going to be talking through all of that. Obviously, like I said, earnings season. We got day 2 of the banks today, which was not so great. A lot of interesting news to go through. It's been a rough week for the stock market, really. And today, if you've been invested in the NASDAQ or the S&P 500, it's been another rough day for you in what is turning out to be a pretty rough week. I'm going to tell you why we're seeing some of those moves, kind of tracing back some of that stuff from last week. Also, bond yields. We are back up over 2.75% on the 10-year note. Going to talk a little bit about why that's happening, what's going on, and some of the kind of chain reaction or the effects, the ripple effects of that 10-year move. Also talking through what data we got this week. CPI was the big one, the Consumer Price Index, telling us what inflation is looking like for us consumers, but also the PPI, Producer Price Index, dropped earlier this week. That was a big number. We'll talk through that, as well as today's retail sales report and the University of Michigan Consumer Sentiment Index. That's what all we'll be going through. And I'm going to tell you what to look out for next week. It is a big week for the housing market. We got some big news on the housing market today. Next week, we're going to see a number of different indicators, national, weekly, daily, all kinds of things. So I'm going to tell you what to be looking out for then. So again, thanks to everyone for tuning in to the live stream. Checking in on the stock market right now. Like I said, it's a rough day. Unless you're in the Dow, you're breaking even if you've got that Dow Jones Industrials ETF. That's about 0.4% on WSJ.com. The S&P 500 down about 0.75%, and the NASDAQ down about 1.6%. Recovering a little bit of that loss from earlier today, but still in tough territory, or still looking like things are a little bit rough there. We've got the U.S. 10-year yield up about 2.8% right now. Things really, moving in sort of a negative direction if you are a bond holder. Yields going up, which means prices going down, which means if you're holding the 10-year, you're losing money. Oil up again today. We're up about 1% on WTI. Brent crude up a little over 1% as well. And gold down about 0.5%. Checking out the crypto market, Bitcoin down 3% today, Ethereum down 2.6%. So, a tough day in the market. We're seeing kind of a sell-off across the board in all asset classes. Just checking in real quick, want to hit you with a little bit of the news that we've got today. The big story, obviously, Elon Musk talking about buying Twitter. The market, though, is saying, we don't believe you. You need more people. Elon Musk putting out there a bid of $54.20 per share for Twitter. Money that he doesn't necessarily have. He could borrow from his stake in Tesla or his stake in SpaceX. We're seeing the shares of Tesla down today, maybe on the expectation that Musk will sell more shares, but Twitter stock declining today. And again, Musk put up that target of $54.20 a share. The stock price for Twitter not anywhere near that, and in fact has gone negative today. So, you got a little bit of a pop when the news initially came out, but the market's saying, nah, Elon, we don't believe you. You don't have the money. We'll see how that goes. Maybe he'll get more serious. Maybe he won't. Also on WSJ.com this morning, Jason Furman, former advisor with the Obama administration, out with an op-ed about inflation. And one of the things that I think really doesn't get enough attention, a lot of people talk about wages, spiking up and that spiking inflation, but the CPI print showed us we got 8.5% inflation. but nominal wages not adjusted for inflation, only rising 5.6%, which means that actual wages, inflation adjusted wages, down 2.7% for workers. So again, workers actually losing pricing power and losing more pricing power, even though those wages are rising. And 2.7%, if you remember watching from a video we did a couple weeks ago, 2.4% was what workers lost last year. So we're seeing that wage loss accelerating. That's not good. That shows that people's buying power is further being eroded by inflation. Also, the European Central Bank had its meeting today, came out basically doubled down on what they've been saying for a while. We are going to stop net asset purchases in the third quarter, but the market not really feeling that. The euro hitting a 2-year low versus the dollar. We don't talk about currencies. It's one of my first loves, FX, but very important to watch as that euro level sinks. That euro dollar level, one of the biggest, most watched currencies in the market. So hitting a 2-year low versus the dollar, definitely important and something to keep your eye on for the future. Again, we are doing this live stream. I am Dion Rabouin. You are on my YouTube channel. Thank you for tuning in. We're talking everything markets. We're going to go through what all happened this week, and I'm going to talk about what you guys should look forward to next week if you're an investor, if you're watching markets, if you're concerned about the economy overall. So let's get into it. Let's talk a little bit about earnings season, which kicked off this week with JP Morgan Chase, the US's largest bank. Profit declined by 42%. Now that sounds rough, but they still had a profit of $8.28 billion this quarter. Last quarter, in the first quarter, $8.28 billion of profit. Most of that miss on their profits and on earnings was from loan loss provisions. Basically what that means is they expect to or are just preparing to potentially lose money from loans that they've made that are not paid back. They're putting money to the side. A lot of this was money that they had put away in the first quarter of 2020, then in 2021, as it was clear, or it was clear to CEOs and executives that, you know what, the pandemic isn't going to cause this long-lasting recession. They wrote those loan losses off the books and actually had negative loan loss provisions. Now we're comparing first quarter 2022 to first quarter 2021. And those losses look significant because they're not making anywhere near as much profit as they did because they're just not putting money away. It's kind of like if you made $1,000 last month and the year before you made $1,000, but you put, now you're putting away $500. Well, now you've only got $500 left and you only made $500 after you put that money away. Last year you didn't put any money away, so you had $1,000. That's basically what's happening here. JP Morgan, a lot of other banks, we're going to get into that as well. But want to talk a little bit about what that JP Morgan earnings report told us about the economy. CEO Jamie Dimon warning that Chase is building up its credit reserves because of, quote, higher probabilities of downside risk. However, the loan loss provisions they took, not very high according to historical averages. We'll get into that. Consumer spending on credit cards at JP Morgan Chase rose 29%, a 64% increase in spending on travel and entertainment. That speaks well for services bouncing back up. Again, we've got to even out the market. People are spending a lot on goods, and that's kind of gumming up the works. And that's a lot of these shipping supply delays that we've seen, things like that. When they spend more on services, that balances things out. We get a more balanced economy, and we can kind of bring down those delays in the shipping industry and sort of start to even out the economy. Hopefully then inflation comes back down. Companies maybe stop raising prices at the same rate and things like that. So that number is a good sign for the economy. Again, 29% increase in credit card spending, 64% increase on travel and entertainment. Also, credit card loans, The Fed put out this report back in a couple weeks ago about what happened in February. We saw credit card loans increasing 15%. This is the trend I told you guys to watch out for on the live stream a couple weeks ago. The Fed's G19 report that showed consumer credit surged $41.8 billion in February, and essentially $42 billion, a 20.7% increase in consumer credit. So again, watch out. Consumers are obviously taking out a bunch more credit. Credit is about to start getting much more expensive if the Fed raises rates, as they say they're going to do. So will we see that really break down? Are consumers kind of seeing as prices rise, oh, let me go make these purchases now, and then they're going to pull back? or will this continue? That's definitely something to watch out for. Another very interesting part of this JP Morgan earnings report, auto loan originations dropping 25%. We saw in the CPI report that auto inflation actually declined 3.8%. That was one of the big things that brought down the CPI and kept it from being even higher than it was on a month-over-month level. So definitely something to watch out for there. We saw a 41% jump in used car prices, a 12% jump in new car prices. So prices rising, consumers not buying, they're declining and making less purchases. 25% drop in auto origination at JP Morgan Chase. We saw this through a number of the different banks over the last couple days. So definitely something to watch out for. What does this say about the economy moving forward? Deposits, this is a good sign. Deposits increased by 15% at JP Morgan Chase. Again, the largest bank in the US, showing a 15% increase in deposits, shows that consumers are still cash rich. They're still putting money away for a rainy day. That's a good sign for the economy. It means that if things do go wrong, there's a cushion and a buffer built up to keep folks from, having to rely on government services or not being employed or not spending. If something goes wrong, folks can still keep spending because they've got that money put away. These are good signs. Consumers have more money. Seems like they're just spending it a little bit more cautiously. So that's not a bad thing. That's not a bad thing. We'll see. I'm going to tell you about what happened with retail sales a little bit later. Again, want to just thank everyone who tuned in on the live stream, seeing that more folks are trickling in. Appreciate you. I'm Dion Rabouin. This is the Wall Street Journal. I'm a reporter for the Wall Street Journal. This is my YouTube channel. Thank you for tuning in to the live stream. We're talking all things economy. Other banks want to talk about want to talk about earnings. Goldman Sachs, again, we saw, this is a theme we're seeing. Profits down 42% in the first quarter for Goldman Sachs. Wells Fargo, profits down 21%. Citigroup, profits down 46%. Morgan Stanley, profits down 11%. Now that sounds catastrophic, but actually Morgan Stanley and Citi beat expectations. So again, a lot of this is coming off of loan losses. These companies are putting more money away in case people don't pay their loans. And that's not necessarily a bad thing. We're just getting back up to kind of historical levels. In the first quarter, banks took a lot of money for loan loss provisions off. Now they're putting it back on. The loan loss provisions were only about $3.2 billion, $3.2 billion. The historical average going back to 2009 is about $10 billion. Over the last 5 years, it's about $6 billion. So not even rising to that level. A lot of folks have said, watch out, this could be a sign of recession. Banks are preparing for recession. That's not what the numbers tell us. So trust the numbers right now. Banks getting a little bit more worried than they have been, but doesn't seem like they're actually worried about big loan losses. And we saw the market really respond with selling off Chase, but the banking sector overall has held up relatively well. Remember, we were expecting 36% decrease in profit growth for banks and for the financial sector, according to FactSet for this first quarter. Banks really just coming in, meeting that. Not as much profit, still lots of profit. Banks still making lots of money, so don't need to cry for them just yet. Again, looking at the market broadly, we are down, like I said, today. We were down for the week. It's looking like, one thing I thought was interesting was on Tuesday, it looked like we were going to get a rebound, kind of that typical buy the dip bounce that we've seen after Monday's losses. We did not get that, and instead ended the day lower. And actually, the S&P 500 finished below 4,400 for the first time since mid-March. The NASDAQ finished below 14,000. Those were two very important kind of psychological levels for the market. It looks like we're going to be finishing lower than that today, which means we'll finish lower than that for the week. Something to watch out for. Does this bearish momentum continue? Does the market continue to keep going down, even though we've gotten some decent news about the economy? How are stock market investors taking that news? Again, want to thank you guys for being a part of the live stream. This is what we're talking about: markets, economy, all the things that go together to really show how money is moving and how money is going to move looking forward. You know my favorite topic, bonds. The 10-year yield at 2.8%. We are again moving towards that 3% level, which is going to be important for a lot of folks because at 3%, it becomes really attractive to move some of that money into the 10-year note, into the 10-year yield, and to move some of that money maybe out of the stock market, which has been volatile, which has been showing losses like it is today. So 2.8%, that's a pretty attractive number if you're an investor and you're taking on less risk than you are potentially with the stock market. Something to look out for. The CPI report that we got, a lot of folks, I was reading a lot of commentary from folks like TD Securities, Barclays. A lot of these people were saying, you know what, I think we may have peaked. We may have peaked on the CPI at 8.5%, which was the report that we got on Tuesday, and now we're coming down. If that's the case, it's very interesting to see the 10-year yield continuing to rise higher, suggesting that more inflation is priced in for a longer term period for the market. So definitely something to look out for. Another thing that was interesting about where bond yields are, just today we got the report from Freddie Mac, which is the government-tied organization overseeing mortgages, that mortgage rates hit 5%. Now that's a big number. It's a big psychological number, and we're going to be talking about that. I got a video coming out later today, hopefully, that's going to tell you all about what that 5% number means, why it's a number that economists watch, and why it's a number that is going to price a lot more people out of the housing market if rates stay at that level. So please be sure to come back and check out my page for that video that's going to be dropping later on today. The other thing to note is that 5% level, according to the Mortgage Bankers Association, hasn't been hit since 2018. According to Freddie Mac, which reported it today, that's the highest mortgage rates have been since 2011. So more than 10 years since mortgage rates have been as high as they are right now. But in 2018, when we were around these levels, the Fed was ending its hiking cycle. Right? The Fed was coming to the end of raising US interest rates, and rates were actually about to go down in the next couple months. This was in October 2018. Right now, the Fed is doing the opposite. The Fed is about to just begin its rate hiking cycle. They've only raised once, that was in March, so rates are going to actually increase higher. That's going to mean higher rates for auto loans, it's going to mean higher rates on credit cards, things like that. And we're going in a bit of the opposite direction from where we were in 2018 when rates were last this high. So definitely something to watch out for if you're watching the mortgage market. This might not be a ceiling. This could be something like a floor, but again, definitely something to watch out for when you're watching that 10-year yield, because that goes directly to mortgage rates. They're tied pretty tightly. Also, MBA, the Mortgage Bankers Association, had an interesting report out yesterday talking about this 5% number, but also pointing out that overall mortgage originations are expected to decline by 35.5% for 2021. Again, a 35% decline in mortgage originations. That's just people taking out new mortgages, whether that be for a refinance or to buy a new house. Now, a big portion of that is refinancing, and that number has fallen like a stone over the past few months. Refinancing going from about 70% of all mortgage originations to down to 50 to 40 to now it's at 37.1% of all mortgage applications. That is a significant number. We also got this week a number of Fed speakers, influential Fed speakers, including Ms. Lael Brainerd, who is a Fed governor, expected to be confirmed as the vice chair very soon. We don't know when that's going to happen, but it's expected to happen soon. She again kind of coming out and saying, hey, you know what, that 50-point increase that the market is already priced in, we're probably going to do that. We also had James Bullard, who was a voter on this year's rate committee, saying, yeah, I think 50 basis points is understood, and that seems like a reasonable thing for us to do. Another, Thomas Barkin, who is a non-voter, but also kind of coming in, and Charles Evans from the Fed Bank of Chicago, saying, yeah, you know what, I think this is likely what we're going to do. So market has already priced in 50 basis points, and that looks like it is locked in for May. We'll see what the communication starts to look like for June. And, you know, what we've seen from CPI really has not suggested the Fed could back off, but maybe we've peaked. Maybe we've hit the height of where inflation is going to rise, and we'll see about that. Like I said, we got that 8.5% number on CPI, highest since December 1981. We saw Credit Suisse, Barclays, Bank of America, and of course TD Securities, as I mentioned, all saying, yeah, I think we've peaked. So some big names coming out there and saying that we've hit the highest that inflation is going to go. We should start to come down. None of them, however, expect to see inflation getting back toward the Fed's 2% goal, which is what they strive for. So we could see the Fed having to tighten rates, having to raise rates, and really kind of tighten up the economy for quite some time. Another sign that that could be happening is PPI, Producer Price Index, which is the cost that businesses are paying. That hit a record high, 11.2% year over year. And as we've seen in an inflationary environment, businesses pass those costs on to consumers. I talked to my man Lou Breen from DRW Trading. He's the head US rates strategist there. He told me that it's really PPI and CPI are being motivated by two very different things. PPI seems to be dealing a lot more with this war in Ukraine and the Russia-Ukraine conflict, whereas CPI seems to be getting dragged down a lot by the fact that we're not getting as much of that stimulus. Consumers aren't getting that big boost to their bank accounts that they were a year ago, and now without that, you could see spending start to tail off and inflation for consumers start to tail off, but for businesses, prices continue to rise. So we already know that businesses raise prices, that boosts inflation, but when they don't have the pricing power, when consumers can't afford it, they tend to back off that. So we will see what happens there as we come through moving forward at the rest of the year. Retail sales, also that came out just this morning. We saw a 0.5% increase. February's number also revised higher from 0.3% to 0.8%. That 0.5% number is respectable. It's decent. It means consumers are still spending more in retail sales, but it's about half of the increase month over month as we saw in the CPI. So inflation is running at about 1.2% a month. Retail sales running at 0.5% a month. That's not a recipe for success. So keep your eye on that. One positive note that we did see was the University of Michigan's Consumer Sentiment Index increased to 65.7. We are still at around the lowest levels in 10 years, but that's up from reading of 59.4 in March. So we're up about 6 points. And you saw those increases in the report coming from a big increase, almost 30% increase in the year ahead outlook for the economy, and a 17% jump in personal financial expectations. So people getting a little bit more optimistic about the state of the economy. That is a good thing. And we finally saw that from the University of Michigan's report. So again, maybe we're hitting the top on inflation. Maybe we're hitting the bottom on consumer sentiment. And those are both good things. Again, want to thank everybody who's tuned in so far for the live stream. We've been going on about 20 minutes. So I want to thank everybody who started and who stuck with me, everyone who tuned in, who kind of caught this or caught the alert on YouTube. Appreciate you guys tuning in. Again, we'll be doing this again on Monday, and hopefully going forward, we'll just be trying to, get an opportunity for me to just talk with you guys direct and straight and tell you what's going on in the markets and the economy, things you may have missed from this week. So again, let's talk. We've talked about this week. We've got a bunch of big data reports. I think we have squarely seen what inflation is doing and what it's doing to the market. It's sending stock prices down. It's sending bond prices down and yields up. And there are some expectations from analysts, from economists, from folks who watch these things that we are hitting the top on inflation, potentially the bottom on consumer sentiment. Those are good things. Next week, we get a lot of housing data. So we get the NAHB, National Association of Home Builders, Housing Market Index. That's closely followed, and that's going to tell us what are folks doing. We have seen this trend for a number of months where buying actual number of houses sold drops, but the prices rise. Does that continue, and at what level? We're seeing double-digit increases on housing prices, and we're seeing single-digit decreases on housing purchases. Will that continue? Because that reduces the stock of houses available, and it pushes the prices up higher, and it reduces. So we're kind of in a vicious circle right now for the housing market. We'll get that NAHB Housing Market Index next week, as well as U.S. housing starts and building permits. That's a little bit look ahead. How many housing starts and building permits were issued? What are folks thinking in terms of building? Because we need a lot more supply to bring prices down, especially with mortgage rates at 5%. We also get that existing home sales report next week. That's going to be big to watch that trend. So again, what do bond rates do? And as we reach this 2.8% level that we're at now and move closer to 3%, what happens on mortgage rates? And how does that affect home affordability and overall inflation? These are all things that we are going to find out more about next week and that we learned a lot about this week. Again, as we look back at the stock market, let's take a check-in. The Dow is incrementally negative. It's down about 0.03%, still about flat on the day. The S&P 500 is still down about 0.75%. The Nasdaq up about down about 1.6%. Nasdaq is down about 1.6%. Those rising bond yields scaring investors again, as we see. Recap again. Just to go back and talk about everything we've talked about. We talked about earnings season. JP Morgan Chase and the banks having a rough go of it, but this was expected. Nothing to get super excited about or super distraught about if you're an investor. The dollar hitting a 2-year high, or the euro hitting a 2-year low against the dollar. That's big on the ECB meeting, the European Central Bank meeting this morning. Them saying, yes, we are going to slow net asset purchases, but not right away. We're not in a hurry. We're going to get it done. And, gold down, oil down, kind of a real down day to end this short trading week for the market. Next week, look at housing. We'll be watching those reports. So want to thank you guys all again for tuning in to this live stream. I'm Dion Rabouin. This is my channel on YouTube. Appreciate everyone who tuned in, whether you started from the beginning and stuck with me or jumped on midway through. We are going to wind this down, but thank you all so much for tuning in to the live stream, and I hope you'll be back with us when we do this again Monday, and looking forward. And I look forward to seeing you guys all